Okay, let's unpack this. We're in an era where AI can, well, shrink the time to launch a really sophisticated cyber attack from days down to just minutes. So the big question is, can one company's strategy, consolidating that whole defense shield, truly create an impenetrable fortress for businesses today? That's really at the heart of our deep dive. And the answer, as you'll hear, it's not quite that simple, especially when you look at how the market's valuing the company right now. We're diving into Palo Alto Networks, Inc. That's ticker PANW on the NASDAQ. Our analysis date is August 19th, 2025, and the share price we're referencing is around $177.09.
Right. And our job today really is to take all this detailed research and help you cut through the noise. We want to get to the core insights, especially looking at that fascinating tension between what looks like a really strong business fundamentally and, well, its current market price.
Absolutely. So to help guide you through, we've split this into two parts. Part one, I will dig into the business itself, management strategy, and the financials. Then, in part two, we'll tackle market sentiment, who owns the stock, the risks involved, and, wrap it all up with our conclusion. Just before we jump in, a quick heads up, this deep dive is powered by Stock Analytics AI. Please remember, you can like and subscribe to the Stock Analytics AI channel. For just $4.99 a month, members get priority deep dives on specific stock tickers. And over the next few months, we're covering all the S&P 500 stocks with exclusive priority access for members. If you just want a one-off deep dive on a particular stock, just drop us a super thanks. Okay. All right, let's get started. Chapter 1, Understanding the Business, the Digital Fortress. So Palo Alto Networks, their main business model, break down into two bits, right? There's product, that's the hardware, the software licenses, the foundational stuff. And then there's subscription and support, that's the recurring revenue, the cloud services, tech support, and that's growing fast.
Exactly. And the absolute core strategy, the thing that really defines them now, is what they call platformization. Look, this isn't just about selling more boxes or licenses. It's a fundamental shift. They're basically betting that companies are just overwhelmed managing like dozens of different security vendors. That best-of-breed approach, it's becoming unsustainable. Nikesh Arora, the CEO, he put it pretty bluntly, a fragmented defense is no defense at all against modern threats. So their pitch is this unified platform. For customers, it means less complexity, lower total cost of ownership, hopefully. And for Palo Alto Networks, well, it means a really sticky customer base and lots of recurring revenue. They're selling integration as the best defense.
Right. So not just pieces of the puzzle, but the whole picture already put together. How do they actually structure that solution for customers?
Yeah, good question. They basically organize everything into three main interconnected platforms. Think of them as pillars of this digital fortress. First up is Strata. That's the foundation, network security. It's built around their next-generation firewalls, or NGFWs. And these aren't just basic firewalls. They're advanced. They use machine learning, and they come in different forms, physical boxes, virtual, even containerized. Then there's Prisma. This is a huge growth engine for them. It focuses on cloud security and what's called SASE, Secure Access Service Edge. So Prisma Cloud secures those cloud-native apps everyone's building, super important. And Prisma SASE, that connects remote workers securely to their applications wherever they are, vital for today's world. And finally, Cortex. Think of Cortex as the AI brain for security operations, or CCOPS. Their main product here is Cortex XAM. It's pitched as the CESO of the future. It uses AI to automate finding threats and responding to them, and is boosted by their, well, pretty famous Unit 42 threat intelligence team.
Wow,
Yeah.
that's a really wide range of capabilities. And when you look at the big picture, that scale itself must be a huge competitive advantage.
Oh, absolutely. It really is. Palo Alto Networks is, they're a dominant force. They've got over 70,000 customers, organizations in more than 150 countries. That includes 85 of the Fortune 100.
Yeah.
That's impressive. And they just crossed a $10 billion revenue run rate milestone.
Hmm.
That really underscores their leadership. So their value proposition isn't just buy our firewall or buy our cloud security. It's we deliver better security outcomes because we integrate everything.
Mm.
They argue pretty effectively, I think, that this unified platform is just better at stopping sophisticated attacks than, a messy patchwork of different tools.
Okay, so their scale is huge, but zooming out even further, the whole cybersecurity market itself is, well, it's booming, isn't it? Driven by, constant cyber attacks, digital transformation, cloud migration, IoT, all of it. Projections show it growing from maybe $227 billion this year, 2025, up to over $350 billion by 2030. That's like, what, a 9.1% compound annual growth rate? Pretty healthy.
Yeah, incredibly healthy. But that growth attracts a lot of competition. And it's fierce out there. You've got direct platform rivals like Fortinet. Cisco is also trying to do the platform thing. But then you also have these really strong specialized players, the best-of-breed guys. Think CrowdStrike for endpoint security, Zscaler for cloud security gateways, Okta in identity. So the really critical question, the million-dollar question maybe is, will customers ultimately go for the all-in-one convenience of a single platform like Palo Alto's? Or will they keep picking and choosing, assembling their own stack from what they see as the best individual vendors?
That is the big question. What's your sense of how that's playing out right now? Is the platform approach winning?
My sense is, yeah, the momentum is definitely shifting towards integration.
Yeah.
Just the sheer complexity, the alert fatigue, managing dozens of security tools is becoming a nightmare for big companies. And that's exactly where Palo Alto Networks' platform strategy really resonates. Plus, you've got regulations acting as a tailwind. Things like GDPR, IPA, and that new SEC rule, the one requiring companies to disclose major cyber incidents within 4 business days. That kind of pressure pushes companies towards having a more unified, visible, AI-driven system like Cortex XIM. It makes reporting easier, response faster.
Right. So the regulatory environment is actually helping push customers towards their model.
Makes sense. And I guess it's not easy for someone new to just jump into this space and compete at their level. No, not at all. The barriers to entry are, well, they're huge. You need massive, ongoing R&D spending. You need years to build the kind of brand trust that big enterprises demand. You need global reach. And finding the cybersecurity talent, that's incredibly difficult and expensive. Palo Alto Networks has built all of that over years.
So they've got the scale, the broad platform, but what really gives them that edge? What's their competitive advantage, their moat, as they say?
Well, it's multifaceted, really. First, their brand is incredibly strong. In cybersecurity, they're a top name. Then, economies of scale. Their huge revenue lets them spend massively on R&D. And their enormous customer base generates just vast amounts of threat data, which feeds back into their AI, making their products smarter. That's a powerful flywheel effect. And crucially, that platform strategy itself, it creates really high switching costs. Once you've built your security around Strata, Prisma, Cortex, ripping it out is complex, costly, and risky. That's stickiness. Plus, they have unique assets like that Unit 42 threat intelligence team. That adds a lot of credibility and insight.
Okay, that paints a picture of a really dominant, well-defended business. But you mentioned earlier, kind of counterintuitively, that this platform push might actually be causing some short-term growth issues. How does that work?
Yeah, it seems odd, right? But it's a really important nuance. Look at their guidance. Revenue growth for fiscal 26 is guided at 14%. Now, that's still good, but it's a noticeable slowdown from, say, 25% back in fiscal 23. Part of that might actually be because of the platform push. These big, complex, multi-product platform deals, they just take longer to sell. The sales cycle is longer, more complex. Also, they've made some changes to billing cycles, trying to get more revenue recognized up front. That can sometimes delay when certain revenue actually hits the books, impacting the reported growth rate in the near term. So you get this tension between the long-term strategy, which makes sense, and the short-term numbers the market is watching so closely.
Ah, okay. That makes sense. Building that big platform foundation takes time, and maybe the growth looks a bit slower while that's happening. Let's pivot now. Chapter 2, Management Evaluation. The person leading this charge is Chairman and CEO Nikesh Arora. He joined back in June 2018. He's got a pretty stellar background, right? Famously scaled Google's ad business from like $2 billion to over $60 billion, then was at SoftBank. And since joining Palo Alto Networks, he's really driven this pivot from mainly hardware to this recurring revenue software platform company. He's got a reputation for being strategic and very discipline-driven.
Yeah, definitely. And in terms of communication, they're generally pretty direct. They clearly articulate the platform strategy, provide lots of metrics. However, there has been some criticism. Some analysts argue that certain accounting changes, particularly around those billing cycles we mentioned, might be, let's say, masking some underlying organic growth challenges.
Yeah.
Something that definitely warrants a closer look, requires some scrutiny.
Masking challenges. That sounds potentially concerning. Suggests maybe not full transparency. How seriously should investors take those criticisms, especially when management is pushing this big platform story so hard?
Well, it's a fair point. Companies, they always want to present their results in the best possible light. That's normal. What the criticisms might suggest isn't necessarily dishonesty, but maybe that the underlying organic pace of growth, stripping out those billing changes, might be a bit more modest than the headline numbers suggest. It means you, as an investor, really need to dig into the supplemental data they provide, not just take the top-line numbers at face value.
Okay, got it. Look beyond the headlines. So we've seen Aurora's strategic vision. How does that translate into how they spend their money? Capital allocation, M&A, shareholder returns?
Right. So historically, their M&A was more about build and buy. They'd make these smaller tuck-in acquisitions, companies like Crypsis, Expanse, Bridge Crew, to grab specific tech or talent.
Hmm.
But the recent agreement to acquire CyberArk, that is a completely different ballgame.
Monumental, you called it earlier.
Mhm.
Sounds like it.
It really is. We're talking a $25 billion deal, mix of cash and stock, easily the biggest bet the company's ever made. The strategic thinking is they need to get into identity security in a big way. Aurora believes that market is at an inflection point, especially with AI and machine identities becoming so crucial. So the goal is to make identity security a whole new core pillar alongside Strata, Prisma, and Cortex. But what's really fascinating and maybe a bit scary is how this just fundamentally changes the investment thesis. It's not just about organic growth and smaller tuck-ins anymore. This is a massive M&A integration story. That introduces a whole new level of execution risk, much bigger than anything they've dealt with before, financially. They paid a 26% premium for CyberArk. The deal is expected to add to revenue and gross margin right away. But, and this is a big but, it's not expected to add to free cash flow per share until fiscal year 2028. That's a ways off.
Wow, yeah, FY28 for free cash flow accretion. That definitely stands out. And speaking of cash, you mentioned Palo Alto doesn't pay a dividend, right? They reinvest for growth. They have done some share buybacks. But that CyberArk deal, using stock as part of the payment, that implies pretty significant dilution for existing shareholders, doesn't it?
It absolutely does, and that ties into another key metric, return on invested capital, or ROIC. For years, Palo Alto's ROIC was actually negative because they were investing so heavily, but it dramatically flipped positive, hitting 13.37% in fiscal 24. That was kind of the validation of the platform strategy paying off. However, the CyberArk deal basically resets that metric. You're adding $25 billion to the invested capital denominator. That's going to push ROIC down significantly in the short term. Investors now have to believe management can generate enough profit on this vastly larger capital base to make it worthwhile. It's a huge gamble.
Okay, let's transition to Chapter 3, financial analysis. So as of our analysis date, market cap around $117.67 billion. Definitely large cap tech. Revenue growth has been impressive historically, but like we discussed, it is slowing down just because they're getting so big. We saw growth rates near 30% a few years back, now down to mid-teens. Guidance is 14.8% for FY25, 14% for FY26. It's that law of large numbers kicking in, but it's critical for how you think about valuation. Profit margins for FY25 look pretty good, though. Gross margin high at 73.4%, and they've made real progress on GAAP operating margin, 13.5%, and net profit margin, 12.3%. That's solid. And free cash flow, that's been strong and growing, $1.79 billion in FY22 up to $3.10 billion in FY24. That strong cash generation is, typical of a good subscription business.
Absolutely. And financially, they look pretty stable. They've recently hit consistent GAAP profitability, which is a big deal for a company that was focused on growth for so long. $2.58 billion net income in FY24, $1.13 billion in FY25. Now, if you just glance at their debt-to-equity ratio, it looks high, around 2.0. But this is a classic case where you need to understand the business. A huge chunk of their liabilities is deferred revenue. That's cash collected up front for subscriptions they haven't delivered yet. It's an operational liability, not financial debt like bonds or loans. Their actual financial debt is tiny. Long-term debt-to-equity is just 0.05, very low. Same story with the current ratio. It looks low, 0.94, which might suggest liquidity issues. But again, it's because that massive deferred revenue sits on the balance sheet as a current liability. It's just the nature of this subscription model.
Okay, so the balance sheet needs a bit of interpretation. Good to know. What does all this mean for valuation? How does the market actually see this company? Let's move to Chapter 4, market sentiment. Looking at Wall Street analysts, the view is, overwhelmingly positive, very bullish. The consensus rating is basically buy or strong buy. Something like 79% of analysts rate it that way. The average 12-month price target is hovering around $210. That suggests, potential upside of over 20% from the current price. And recent news flow, especially after their Q4 earnings beat and the strong guidance for FY26, has been really positive. The CyberArk deal is mostly framed as bold, strategic.
Right. But then you look at some other market indicators, and you get this really interesting contrast. Short interest, for example, it's noticeable, around 5.1% of the outstanding shares. That means there's a significant group of investors, managing billions, actively betting against the stock price going up. And technically looking at the chart, the stock is trading quite a bit below its 50-day moving average, which was around $191, and also below its 200-day average of $187. That suggests negative momentum, both in the near term and longer term.
Wow. Yeah, that is a big disconnect. Analysts super bullish, price targets way up here, but short sellers are active and the price trend itself looks negative. Why such a gap? What explains that?
Well, it could be a classic case of story
versus, well, current reality or maybe perceived risk. Analysts often focus on the long-term strategic story, the quality of the business, the market opportunity, and Palo Alto Networks scores highly there. But the short sellers and maybe the broader market momentum might be reacting more to the very high valuation, the decelerating growth rate we talked about, the huge integration risk with CyberArk, or maybe just broader macroeconomic concerns about interest rates. The trading below moving averages suggests that right now the sellers are more motivated than the buyers.
Interesting. Let's look at who actually owns the stock. Chapter 5, Ownership Structure. It sounds like it's mostly big institutions, right? Something like 80 to 88% held by the Vanguards, BlackRocks, Morgan Stanleys of the world. That usually signifies, a core, high-quality holding for big funds. But it can also mean more volatility if those big players decide to sell.
That's exactly right. High institutional ownership is typical for a company this size and quality. Now, insider ownership. Executives and directors own about 2.5% of the shares. Not insignificant. But here's where it gets really interesting. And maybe a bit concerning, depending on your perspective. The data on insider transactions shows a really stark, really consistent pattern of selling. Over the last 12 months, insiders sold over 7 million shares. How many did they buy? Just about 280,000. And look at just the last 6 months. 110 open market sales by insiders and zero, absolute zero, open market purchases. We're talking key people. CEO Nikesh Arora, the former CTO near Zook, selling hundreds of billions of dollars worth of stock.
Whoa, wait, zero purchases in 6 months by the people running the company while they're telling the market how great things are. That feels like a major contradiction. A flashing red light, maybe? How do you square that circle?
It's tough to square, honestly. It's the ultimate contradiction, isn't it? The public narrative from management is exceptionally bullish, strong vision, huge market, great execution. But their personal financial actions, they seem decidedly less bullish, relentless selling, especially at these valuation levels. For an investor, you have to ask why. It could certainly be interpreted as a powerful signal from the people who know the company best. Maybe they think the stock is fully valued, perhaps even overvalued right now. It definitely adds a layer of skepticism to that bullish analyst narrative we just discussed. As for ownership concentration, it's pretty spread out among many funds. No single outside entity has a controlling stake.
Okay, that insider selling is definitely something to chew on. Let's move to Chapter 6, Risk Assessment. A SWOT analysis might help structure this.
Good idea. So strengths, we've covered these. Market leadership, that comprehensive platform driving high switching costs, strong brand, massive R&D, great free cash flow, solid foundation. Weaknesses, the biggest one is probably that extremely high valuation, the PE over 100. Then there's the decelerating revenue growth, reliance on stock-based compensation, which dilutes shareholders, and of course the huge execution integration risk from that CyberArk deal. But the big one, opportunities. Success here means nailing the platformization strategy, cross-selling more services into their huge customer base, continued growth in cloud and SaaS markets, monetizing new AI features, and critically, making that CyberArk integration work smoothly and create real value. And threats. Competition is intense. From Fortinet, CrowdStrike, Zscaler, Cisco, others. New disruptive tech could always emerge. A major macroeconomic downturn could eventually pressure IT budgets, even for security. And the nightmare scenario for any cybersecurity company, a major breach of their own systems. That would be devastating for trust.
Right. And it feels like a central challenge is just that scale issue again. The revenue base is so big now, maintaining those high percentage growth rates gets harder and harder. But the stock's valuation seems to demand that high growth continues indefinitely. That feels like a setup with very little room for error. How do broader economic factors like inflation or interest rates fit into this risk picture?
Well, they're hugely important, especially for a stock valued like PANW. Inflation is kind of a double-edged sword. It could pressure customer budgets, but it also increases Palo Alto's own costs. Though cybersecurity spending does tend to be more resilient than other IT areas. Interest rates, though, arguably the biggest macro threat to the valuation. High-growth tech stocks like this are considered long-duration assets. A lot of their value is based on profits expected far out in the future. When interest rates go up, the discount rate used to value those future profits goes up too, and that hits the present value of long-duration assets disproportionately hard. So ironically, the very predictability of their recurring revenue might make the stock price more sensitive to interest rate changes. Geopolitically, those U.S. tariffs from 2025 on hardware were a potential risk, but the company seems to have gotten ahead of it by shifting manufacturing to Texas. They're saying the impact should be immaterial.
Okay, that makes sense. The macro environment, especially rates, is a key risk for the valuation. All right, let's bring it all together. Chapter 7, conclusion. Let's start with the bull case. What's the optimistic view here? Well, Palo Alto Networks is, without doubt, a leader in a critical growing industry. That platformization strategy looks like a powerful moat, locking in customers. Leadership under Nikesh Arora is proven and strategic. They've achieved GAAP profitability consistently, and it's a free cash flow generating machine. And that huge CyberArk acquisition, while risky, positions them for the next big wave in security identity, especially in the age of AI. It broadens their dominance.
Right. That's the bull case. Now, the bear case. It really hinges on that valuation. It looks priced for utter perfection. A PE over 100 is just incredibly hard to justify when revenue growth is clearly decelerating, even if it's still healthy. Then there's the massive execution risk tied to integrating CyberArk. Can they pull it off smoothly? Will it deliver the promised synergies and the dilution from the stock used in the deal? And maybe the most worrying point for bears is that stark pattern of heavy insider selling. The people who should know the most seem to believe the stock at current levels is fully valued, or maybe even overvalued. That's a powerful countersignal.
So recapping the valuation picture, definitely trades at a premium by almost any relative measure. And our educational DCF model, just as an exercise using consensus estimates, pointed towards an intrinsic value somewhere in the $85 to $97 per share range. That's compared to the market price around $177 when we did the analysis. Again, not a price target, just illustrating that potential disconnect our model found.
Yeah. So our concluding outlook is basically this. Palo Alto Networks is, without question, an exceptionally high-quality company. They have a dominant strategy, strong fundamentals, capable management, operating in a vital industry. You can't really argue with the quality of the business itself. However, the current share price seems to have already baked in not just continued success, but pretty much flawless execution for years to come, plus the seamless value-creating integration of their biggest acquisition ever. It feels like the market is pricing it as if everything will go perfectly.
So the final question really for you, the listener, to think about is, how do you weigh that impressive strategic vision, that clear market leadership, against the very significant valuation premium and, maybe just as importantly, the clear actions of the company's own top executives? We really hope this deep dive into Palo Alto Networks has given you a useful shortcut to getting well informed on the company. And hey, don't forget to like and subscribe to the Stock Analytic AI channel. Remember, members get priority deep dives on the S&P 500 for just $4.99 a month. And if you want a specific stock covered just for you, drop us a super thanks.
And the important disclaimer. This analysis was generated by an AI system. It's for educational purposes only and absolutely should not be taken as financial advice. Always do your own thorough research or talk to a qualified financial advisor before making any investment decisions. Thanks for diving deep with us today.